Hello, I am Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. This video has been a challenge to make because it hasn't quite conveyed the message I wanted it to in all the previous iterations I've done of it. So I'm going to prefix it with a prologue, in that when you are looking at your trading strategy, there is something that you need to consider that might not necessarily be the strategy itself. I have seen hundreds of times where the strategy is sound and does exceptionally well with a very good win rate and risk mitigation, but the application of the strategy through a person's aggressiveness or defensiveness destroyed the success rate of the strategy. That is what I want to focus this video on and convey, that when you are working with your strategy, no matter what it is, whether it's a grid bot or a MACD RSI combination or anything you can conceive, the part that can make or break any strategy isn't actually the strategy, but how you apply it through your aggressiveness. With that being said, I want to talk about the experiment I've been running with the French vanilla account. I have a hyper-aggressive strategy, an aggressive strategy, and a strategy that can be either hyper-defensive or just defensive. And I want to show that just how these strategy differences in application can be absolutely disastrous or stellar. So right now we see on the chart, we have my hyper-aggressive strategy, where the only thing it does is take trades at the level of the spread. That's the only difference. So basically it takes trades every 1 pip. And if I zoom in onto a candle, you can see just how many trades it's placed. And those trades have consequences, both in finance rates and in profitability. Now, the hyper-aggressiveness of this strategy is in and of itself its worst point. The strategy itself is 100% successful, but the hyper-aggressiveness makes this strategy too aggressive and also unprofitable for a large portion of the time. Long-term profitability is hit or miss because of the aggression level. And we're going to go through and actually see that in the logs itself. But we can see that the level of positions taken is just insane. The level of market fluctuations that occur within this process are equally insane. Now, that's not necessarily a bad or a unwanted situation if and only if you can handle the level of aggression that this system requires. If you can handle that aggression, this system can do very well through the process of micro profitability through aggregation. But it takes a huge budget and a deep wallet to be able to sit and withstand a whole market shift. Now let's compare that scenario to a situation that is significantly more defensive, almost hyper-defensive. And we can see the gapping and the spacing between the positions. We are going to go through this more so in the logging, but the visual representation between the two is very significant. And that is something to really be aware of in context of your trading. Now let's take a look at another situation that is even more defensive than this one. Here we are on the Blueberry Cobbler account. There's not much difference, but enough when you look at the spacing between the orders. This isn't necessarily hyper defensive, but it's more than just defensive. The spread and the volatility play more of a significant role, along with the level of take profit. So you see that you can actually have a beautiful strategy, but not do well in the long term in terms of either too little profit or not making enough profit to cover any spreads, fees, and reductions. This is the case in point of trading for any approach. The strategy is only part of the problem. It is only part of the final equation. The machine is really just a small part of what really goes on to the thinking process when you hand your money over to it. Unlike a human trader that can look at the candles and see patterns and just has discretion in terms of whether they want to buy or sell or get in or out of the market, a machine is driven by a mathematical equation where the end result is simply a yes or a no. That's it. So when you trade algorithmically, there are things that the human brain thinks of that the machine simply has no idea of. Things we take for granted. What's called discretionary trading is because we see whether or not we have a discretionary situation. For example, here, a discretionary trader would see this information as a good way to get into the market and then place the bid in early session and let it run. The bot doesn't have that ability unless you can actually program it in. And that's the point. It doesn't understand time. All of this that we see as candles is an illusion to the machine. All it sees is just one single number, the price. Now we can construct candles so that the machine can see them, and that's the whole point of these charts, to give the machine the references that we see. But there's still so much more in context that the machine doesn't get that we do. So now let's get into the actual logs of each of these situations and see just how aggressiveness or defensiveness plays into the actual profitability. Let's start by analyzing the French vanilla account, the Euro USD pair, the hyper-aggressive one. We can see that in October it made money. November was a bloodbath. The hyper-aggressiveness just decimated it. December so far, in only a few days in the month, and it has done pretty well. And we have taken a total of 6,000 trades. So hyper-aggressiveness in this context has really hurt the system in a very harsh and brutal way. So now let's take a look at the actual logs and see where that suffering came in. Okay, we have the log on the screen now for Euro USD for the French vanilla account, the hyper-aggressive one. Now I'm going to adjust the screen a little simply by using the arrow keys to get the log to line up a little bit more readable. I'm going to simply take the year off. And we can see now we have various cells, and the area we want to really pay attention to is the profit. And then of course you see the starting balance here and the rough time it took for a trade to sell. But overall, this is the important thing. These are profits, not losses, and yet look at how many of them are below zero. So you can see that hyper-aggressiveness in this context has hurt the process as a whole, because it's sold in such a way that even though the program thought it was in a profit, because of market volatility and rapid speed going in the opposite direction of the trade, it actually lost money. And that holds true for quite a bit of the trading, far more than it really should. For example, here you see a full 9-cent loss. That's quite significant for slippage. And as you keep going, it just gets worse. So hyper-aggressiveness can be a detriment in that it can eat your profits away, even when you have a clear profit. Now, it looks nice having 6,000 trades, but it doesn't look nice taking a $1,200 loss in one chunk because of the hyper-aggressiveness. That's problem number one. Problem number two is when you're hyper-aggressive, you don't have the space between the trades to let the market breathe. That is, there is a delicate balancing act between being hyper-aggressive and hyper-defensive. The spacing between the trades affects your average, but it also affects your NAV, your net asset value. If your spacing is too small, your average will be wonderful, meaning you won't pay as much in terms of your fees, but if your average is too large, you're going to pay more fees in terms of your financing. So that fine line between paying too much in financing and getting off with less financing is very delicate. But it doesn't hurt you when you take excessive losses. Or excuse me, it doesn't help you. It actually hurts you. So there's a lot of little nuances in a perfect strategy that can totally ruin it. And then we get to the elephant in the room. If you're hyper-aggressive and you don't give room in between each position, you're going to take a brutal number of stop losses. And those brutal numbers are going to hurt. $8 versus a 17-cent profit. Even though aggregation is going to work in your favor because you are being too aggressive in the context of this system, you're going to lose more money than you're going to gain over the long term. Even when you deploy such methods as position reduction to reduce your exposure on the bottom of your trading, it's still not enough to offset multiple stop losses back to back because you don't have spacing between the trades to give the market room to breathe and recover. And that really is, as we can see, we have a large wall of profitability. But none of that profitability saves you against a wall of stop losses. For example, here is a good situation. Look at all of these stop losses back to back. Look at the sizes of these stop losses. These are brutal. Look at what they're actually doing to the budget. They are trashing it. You can see right here roughly the equivalent of a $100 loss in just a matter of seconds, comparatively speaking. Hyperaggression in this context is a disaster. And that is one of your biggest and hardest decisions you're going to be making in your trading, is getting the aggression level of your strategy in line with what you can handle financially. If you have an account that could handle this kind of aggression, this may not be an issue, but most people can't. And this is what destroys 90% of all traders. They actually take on more aggression than what they realize they can handle. Particularly with algorithmic trading. When things go bad, they go bad quickly. When the market moves against you, you are never around to do anything about it. And even if you are, by the time you can react, the bot has already done so, and probably not in a way that you're going to like. We can keep going through this, and you can see trade after trade after trade of profitability, and you can even see how it's making the money back. So the hyper-aggressiveness, when the market is moving in your favor, is really picking up the returns. But all it takes is hitting those stop losses to determine just how much you are over aggressive. So we've already up to $27 from the losses. Let's move this forward. $38. Let's move to the next stop losses. So we've made $47 up from the last series of stop losses demonstrated above. And yet we have another wall, and our losses have accumulated more, wiping out all of our profits. So as you can see, you need that balance. So now let's go and find the next wall of stop losses. Okay, here we go. We've made up some of the money. We've hit another wall of stop losses. And look at the hit the budget took. And then we hit a few more stop losses down here, wiping out more. And again, looking at the way the budget really was massacred. That's really the only way to describe this kind of a situation. This is a massacre to the account. Basically, this is a $250 loss right here. But it keeps going. Another wall. And another wall. The hyper-aggressiveness is really hurting this account. Now we're down to a $450 loss on this demo account because it's just too aggressive. So we can clearly see how the aggression really affects trading. So now let's take a look at an account that is not aggressive, but more defensive. So, using the same French vanilla account, This time we're going to look at USD Canadian. It started out a little aggressive, meaning I was using reduction heavier than I should have been. But by tuning that and toning it down a little bit more, we can see I've made real money. Slow and consistent, but real money. So you can be a little aggressive as long as it's not too much aggression. And for example, for the month of November, this would have paid for my VPS. This would have been a break-even that I could have cashed out and actually paid my VPS and still left money on the account to accumulate for the future. So let's actually look at the log and see how this played out. As we saw from the chart, the spacing between each of the trades is larger. That is, there's room for the trades to grow. We still see that I have a little bit of aggressiveness where I have lost some money. But that aggressiveness will get toned down as I evolve this account. By starting out defensive, you can always make it more aggressive if it's not getting what you want for your returns. But if you start out too aggressive, you've already done a lot of damage. And as you look at the budget, something to be aware of and always keep in the back of your mind. When you're trading more than one pair in the same account, what happens with the other pair is going to affect this pair. So if the other pair is a loser and eats your budget away, your bot needs to really think about how it's going to manage your position sizes as the budget changes so drastically. And we will see that as we progress. All is good right now. We see how both sides are working together, and we see the budget climbing. But then right here, we see the budget drastically drop. That's because the other side, the aggressive Euro USD, just hit a stop loss. So even though this side did well and is doing well, it still is affected by the other pair in the same account. That is, of course, a serious issue. And you see how it affects position sizing. When the balance changes, you see that the bot has to recalculate on the basis of the new balance. For example, 587, 573. Because the bot is always watching the net asset value to determine how much it can trade, it has to make these changes in order to try to avoid a margin call or liquidation. That is not easy. And it still has to deal with its own stop losses along the way. And yes, it will take its own stop losses. But as you can see, because we're not hyper-aggressive, we're not taking a brutal level of stop losses. We don't have a huge wall of 5 to 10 stop losses at one time. This makes it a lot easier to deal with. And you can see that I added a little bit more aggression. That is, I added position reduction. So we see the first stop loss is a little less than the second stop loss. That offset helps me. But we can see the profits. Here I'm making an 18-cent profit per sell versus a very tiny reduction. So you can see just how everything is playing together, where I'm still a little aggressive, but because I'm not overly aggressive, I'm doing somewhat well. I have a long-term approach. that will weather the market and produce a comfortable rate of return. So let's keep looking. And again, you see more stop losses scattered, but now we're starting to see profits in between the stop losses. We're starting to see the impact of how reduction works against a full stop loss. We're starting to see the offsets. And again, we see the first stop loss is not the same as a consecutive stop loss. And because we aren't so close, unless the market really moves aggressively against us, we stand a good chance to be able to make profits in between the stop losses. But sometimes the market is what it is, and we still lose. It happens. But overall, you can see, even when major market shifts occur, we can see that the losses aren't as drastic at one time because I don't have a huge wall of positions that just get ripped through aggressively. So we have $20 worth of stop losses versus $120 on the other side for the hyper-aggressiveness. What you're looking at is a major market movement. And we saw with the other side just these huge strings of stop losses. While these stop losses are devastating, they're not as devastating. So it's a matter of risk versus reward and balancing the level of loss versus your ability to profit in the long run. And you can see the overall impact, how positions changed, how they were managed, metered, how the balance of aggression and defense worked together. So we can see from this point, this was actually our last stop loss. So let's see how this works on this side. So we're at $99.75. We're $25 short of what we actually started with. And we can see that it keeps going up. And you can see that just how profitable this side is. Slow, steady, consecutive approach. It's making a good rate of return. We're now at $20 below break even. And it's doing exceptionally well. So let's, okay, $15. All right, it looks like we took a little bit of a loss there. Probably finance fees. Okay, less than $10. $6 away from break even. $4, $2, $2, $3, $2, $1. And now we're back above what we were. Let's keep going. So we're doing well here. And bang. Here we go. The Euro USD begins taking its stop losses. So we were all the way up to $10,046, and then the other side started taking stop losses. And we can see how the bot is trying to manage its position sizes, trying to figure out how to adjust to the other side losing money. And we can also see the holding times in terms of just what the bot is trying to do and figure out as it keeps from getting itself liquidated. So we can see that the technique is 100% successful and that we have a good level of aggression here. We're not too aggressive, we're not too defensive. We're making reasonable profitability. And we can keep going and we will see how the other side just destroys all profitability. Now mind you, this side doesn't take any more stop losses at all. So it has found its range that it's working in. And that range has been very stable. How much more stable of a profit could this side have made without the other side being so aggressive? Those are all questions that you need to ask. And let's get down to where things really start going bad. Okay. We're at 10,055. And we start seeing the first wave of stop losses as it just decimates the other side. The first wall. And look at the brutality. So we went from $10,055 all the way down to $9,901. All because of the hyper-aggressiveness of the other side. Even though this side has been doing exceptionally well. That is critical. Now, the overall combination of this side working with the other side is hedging. And that's important. A hedging technique is what will keep this whole process running reasonably well. But imagine how much better it would be if the other side wasn't as aggressive and both sides were going against the market with a responsible level of aggressiveness. Here is the actual combination of both pairs on the same account, where we show how the hedging between the two pairs is actually helping to mitigate a lot of the loss. It's still not pretty. The account total is still $950 down. But we can see that the combination of both accounts hedging against each other would do well if they both had the same aggression level. That is the critical point. When you trade with a hedging technique, you have to use the same aggression level on both sides. Otherwise, one side is going to overshadow the other. And sooner or later, you're going to see this situation as the market dynamics move back and forth. This is just one of those circumstances of trading in a random, chaotic market. So we can see clearly that the process, the methodology, the technique works absolutely flawlessly, and it does so with a great deal of high success. The whole thing that killed this technique wasn't even the technique. It wasn't even the bugs that existed in the technique. It was the aggression. So now let's take a look at a real account using live money, real money. Here is an account with real money that I started a few days ago. Not very impressive, but it doesn't need to be. because it's using a technique that will run consistently and simply tick away, earning profitability on a slow and steady rate. And it's using a series of aggressive steps that aren't all that aggressive, meaning my bot is working not defensively per se, but more defensive than the previous examples. When I set up my real money account, I wanted somewhere in between aggressive and defensive. So instead of having a high level of grids, I chose a slightly smaller level of grids, making it more aggressive there. But I am more prone to stop losses. So in that regard, I chose a defensive technique of where my steps and profitability are going to be. And that leads us here, the actual bot, running where it is actually watching the market. And even though I'm using some aggressive techniques, it is still defensive in regards to where it actually makes its purchases. For example, I am tracking volatility so that as the volatility of the market changes, the distance between my trades will change equally. I am tracking spread so that as the spread changes, the positions my bot considers also changes. I am tracking deviations between the positions, that is the actual space between each purchase. And finally, an added layer that is slightly more aggressive is I'm wanting more profit than my deviations. For example, if my deviation was 15 pips, my take profit would be 20 pips. I'm using the 4/3 principle I've demonstrated previously throughout different experiments. So that is an aggressive technique of wanting more profits, knowingly that I'm going to be holding a position slightly longer to get that profits. But by using two aggressive techniques with defensive techniques, I've hit the right spot. I've hit a reasonable level of profitability that just does well. So let's take a look at the actual log entries and see how my profitability really looks with such a small scale budget. So now looking at my live account, real money, we can see it hasn't been running very long. This is literally the very beginning of this account for my selling. We also see that the position sizes aren't that big, and neither are the profits. Now for this particular account, I chose not to use a reduction, and I'll explain that in a little bit. But we can see the profitability is very, very small, but it's being aggregated over time, as we can see within the actual budget itself, how that profitability is slowly adding up. And we get a sense of how long I am holding each position, appropriate to how the market is running. And this includes weekends or times when the market is not closed, where I will hold a position over that non-trading period. So let's actually go through and look more at this, and you can see that's the whole log. That's it. It's not doing a lot, but we have made roughly $1. And that's the whole point and purpose of this technique. It's slow, it's steady. It has a mixture of aggressiveness and defensiveness. And it's done so in a way that, for marking my first year of trading Forex and getting an understanding of learning that market, I've taken and applied everything I've learned into one bot that I don't have to worry about. I will let this bot run for a year, and I'm not going to have to worry about stop losses or anything else, simply because the bot has been built with the proper amount of aggression and defensiveness to weather a full and complete market movement. Now let's talk about that. How can I be so confident that the market won't wreck me when it moves? That's because when I built this bot and I set up the configuration, I spent time studying the market. I spent time looking at the market. I know the market will go against me 15% of the time. And I know the market will go in my favor or sideways 85% of the time. Now I know that one worst case situation, the maximum monthly movement that has occurred in 21 years of studying the history of this asset, is only 2,171 pips. So by using this situation, I know exactly how many steps I can expect and calculate a risk management approach based upon that. And that is exactly what I did. I calculated and based my approach, my minimum number of steps, my minimum number of pip deviations appropriate to exactly what the worst case scenario of one single month is. So basically, in 259 months, only one time has it ever reached this much of a deviation for a single month. This bot looks at the worst case scenario that has been seen in 21 years. Now, can that happen again? Absolutely. It absolutely can happen that another worst case situation can occur. And that is a real world prospect that I need to accept. But I've gone one step further. I know that throughout the entire history of the 21-year period, this is the maximum number of ranges that I will see. So if I take, for example, 100 steps, then I know I can meter out the entire market of 21 years in 6.7 pips. Now, my particular bot is well above that. So even without taking into account the absolute worst possible situation that has been seen in the market, my bot will still survive. Because when you look at this number, the highest market spread, and you look at this number, the maximum monthly movement, the correlation here is it would take 3 maximum movements to equal the total spread of the entire market for 21.5 years. So the process I built when I made my configuration was to consider exactly these numbers. So by using the maximum monthly movement, what I know and have studied 1 month's movement, and then figuring out my worst case scenario there. Roughly 2.1 pips if I were to do 100 levels. I don't want to be that low or that aggressive. So for me, roughly 5 pips works out well as my minimum. But that puts me at about 70, 75 layers. So again, mathematics and statistics of probabilities within the framework of what I am looking for. And because I'm using the maximum monthly movement, I know right away, without taking anything else into account, 60% of the time I'm going to be ahead of the market. Now that's technically speaking because of the way the spot works. 40% of the time, it could take a loss. But since the market is only going to be moving against me 15% of the time, 40% of that, roughly 5 to 6% of the time of the entire market, is when I might actually take a loss, which means I stand a good, reasonable approach of being profitable at least 90% of the time using this technique. Worst case scenario analysis, coupled with the right balance between aggression and defensiveness, will give me a profitability and a potential resistance level to market disruption that will let me not worry about what this bot does. That's the whole crux of the matter. That is really the bottom line. If you can handle aggression, it's wonderful. If you can't, it will wreck you. Your trading strategy is just one component that determines your success. It's actually the easiest component because that's just pure mathematics. The aggression level you apply to your trading paradigm, that's where things get complicated because it can be mathematical, or it can be a gut feeling, or an instinct, or intuition, or countless other constructs that can't be quantized. And that's what can get you into even more trouble. The basic assessment you should use for determining your risk and the level of your aggression is whatever you think you can handle, divided in half. If you think you can handle 10 trades a day, don't go above 5 trades a day. That's a reasonable assessment. But if you want to be defensive, whatever you think you can handle, divide by 4 and only use 1/4 of it. So if you think you can handle 12 trades a day, don't go past 4 trades a day. And a lot of seasoned professional traders, they'll trade until they get to their first loss. Then they completely stop for the day, period. Because by doing that, they keep themselves from revenge trading. So if you use discretionary trading, think about what you're going to use as your rules for trading. If you use algorithmic trading, build them into your algorithm. So if you take a loss, tell your bot to stop trading. Build that in. In my case, with the grid bot, I want it to use the data in the market, of the market, as much history as possible to determine where and when I want to buy and sell. I want my bot to think about the market not as ups and downs, but as one big 21-year range. And that is what this data tells me. I have a range of 21 years. Now all I have to do is split that range up into steps and then simply be patient. If you like this video, please give it a thumbs up and help me gain more exposure on YouTube. If you're not subscribed, please subscribe. If you have any questions, please leave them in a comment below. And of course, you can always visit my support server and ask questions there as well. Thank you for watching, and until next time.